The next big break in the system may not start in stocks. It may not start in crypto. It may not even start in banks. It may start in the place most people still call safe. And that is exactly why almost nobody is ready. If you value calm thinking when the crowd gets loud and late, keep this channel close to you because I am about to walk through the one market that quietly sets the price of nearly everything in my life and yours. When that market starts to strain, the headline usually arrives after the damage has already begun. I have learned that people only notice the bond market when something feels wrong elsewhere. They watch stocks, they watch home prices, they watch layoffs, but the bond market sits underneath all of it like a pressure plate under the floor. Most days it looks boring. Then one day it reminds everyone that boring is not the same thing as harmless. When I say the bond market is next, I do not mean every bond is about to collapse tomorrow morning. I mean the next layer of stress is moving deeper into the system. It is moving from the loud parts people trade for excitement into the quiet part that governments, banks, pension funds, and insurance firms depend on to function. That is a far more serious shift. A bond is just a loan that gets traded. If I buy a government bond, I am lending money to the government. The yield is the return I earn for making that loan. When yields go up, bond prices go down. That is one of the oldest rules in finance, and it still catches people off guard because it feels backward until they live through it. Most people think the bond story is simple. Rates went up, so bonds got hit. Rates will come down, so bonds will recover. That story is neat, easy, and incomplete. I have seen markets long enough to know that the simple story is often the cover story. The deeper story is usually about pressure, incentives, and who has to buy what when nobody really wants to. That is where this gets serious. The United States now carries more than $39 trillion in total debt. The Congressional Budget Office projects a federal deficit of about $1.9 trillion in 2026. That means the government still plans to spend far more than it collects. It also projects net interest costs of more than $1 trillion in 2026. In plain English, the cost of carrying the debt is becoming its own major spending program. I want you to sit with that for a second. More than $1 trillion is not some abstract line in a report. That is money that cannot be used somewhere else. It is a reminder that the debt is no longer just a future problem. The debt is now producing a present cost, and that cost keeps rising as old low-rate debt rolls into new higher-rate debt. The Treasury itself has already signaled the scale of the need. For the January through March 2026 quarter, it projected $574 billion in net marketable borrowing. That means hundreds of billions of dollars had to be raised from investors in just one quarter. And this is not a one-time event. It is part of a larger machine that needs constant refinancing just to keep moving. This is why I never treat the bond market like a sideshow. If Treasury yields rise, mortgage rates feel it, corporate borrowing costs feel it, car loans feel it, private equity deals feel it, tech valuations feel it, real estate feels it, even the government's own budget feels it. The bond market is not one market among many. It is the pricing system behind many other markets. I think that is what so many people still miss. They hear bond market and imagine retired people clipping coupons in silence. That world is gone. Today, the bond market is tied into bank balance sheets, hedge fund leverage, retirement promises, exchange traded funds, derivatives, repo funding, and the daily plumbing of the financial system. When stress appears there, it does not stay politely contained. I do not even need to reach far back in history to prove it. In April 2025, the U.S. Treasury market had a week that made professionals pay attention. The 10-year yield swung sharply higher, around 40 basis points in a matter of days. A basis point is 1/100%, so 40 basis points means 0.40 percentage points. That may sound small, but in bonds, that is a real jolt. The New York Fed later said liquidity, which is just the ease of buying and selling without wild price moves, deteriorated fast. Some measures of illiquidity neared or even exceeded the levels seen during the March 2023 banking stress. Depth in the 10-year Treasury dropped to roughly 1/4 of recent levels. In simple terms, the biggest so-called safest market in the world became thinner and more fragile very quickly. That matters because stress in treasuries is not supposed to look like stress in some tiny corner of the market. Treasuries are the collateral behind a huge amount of the financial system. Collateral is the asset people post to borrow against. If confidence in that foundation starts to wobble, even briefly, the system can become jumpy in ways that look confusing from the outside and obvious from the inside. I have watched ordinary savers get caught by this because they use the wrong mental label. They hear bond fund and think safe cash cousin. Then they open a statement and find that the thing they bought for stability is down 10, 15, even 20%. That feels impossible until I explain duration. Duration is just a measure of how sensitive a bond is to interest rate changes. Longer duration means more pain when yields rise. That lesson was not theoretical. In 2022, the New York Fed called that year's bond sell-off the largest in 40 years. The trough in the move reached about negative 26.9%, deeper than 2013, deeper than 2003, and worse than the 1994 bond market shock, which bottomed near negative 18%. People who believe bonds were a quiet shelter learned that safe issuer does not mean stable price. So I keep asking myself a very simple question, and I think you should ask it too. When was the last time I checked what my safe money was actually holding? If that question makes you a little uneasy, that is not a bad sign. That is usually the moment real risk management begins. The reason I say almost nobody is ready is not because nobody sees the debt. Plenty of people see it. The reason is that very few people are positioned for what sustained bond pressure does to everything else. They are still thinking in separate boxes, stocks over here, housing over there, government debt in another room, but the rooms are connected and the bond market is the hallway. Even the Treasury knows the market has become harder to manage smoothly. That is one reason it has used buybacks to support liquidity. Treasury says those liquidity support buybacks are meant to give market participants a regular chance to sell off-the-run securities. Off the run just means older bonds that are not the newest issue anymore. If officials are trying to make trading smoother, that alone tells me the plumbing matters more than people think. Then there is leverage, which is borrowed money used to make a position bigger. Leverage can make gains look easy in calm periods. It also makes stress spread faster when prices move the wrong way. In March 2025, the New York Fed said leverage funds held about $1 trillion in short Treasury futures positions as one rough proxy for basis trade activity. That is not pocket change. That is a major layer of hidden sensitivity. The basis trade sounds technical, but the idea is simple. A fund tries to profit from a tiny price gap between a cash bond and a futures contract, then uses heavy borrowing to make that tiny gap worth something. It works until funding costs jump, repo conditions tighten, or volatility rises too fast. Then the same trade that looked clever can become a forced seller. Forced selling is where small cracks become market events. I know the first objection people raise. If the economy slows or falls into recession, won't bonds rally? Yes, some bonds can. Shorter-term government bonds often benefit when the market expects rate cuts, but that is not the whole long end story anymore. The long end means longer maturities like the 10-year and 30-year. Those yields are not driven only by recession fears. They are also driven by supply, inflation risk, and confidence in future fiscal discipline. That last piece matters more than most headlines admit. If investors start asking for a higher return to lend long-term because they see bigger deficits, more issuance, and more inflation uncertainty, long yields can stay elevated even while growth weakens. That is how a bond market can stop acting like the public expects. It can stop being a simple recession hedge and start becoming a referendum on policy credibility. One term professionals use here is term premium. That is just the extra return investors want for tying their money up for a long time instead of rolling over short-term debt. When the future looks stable, term premium can stay low. When the future looks messy, it rises. And right now, the future looks messy for a very basic reason. Too much debt has to be sold into a world that is no longer automatically eager to absorb it. Foreign demand still matters, but the picture has changed. As of January 2026, foreign holdings of U.S. Treasuries were about $9.3 trillion. Japan held around $225 trillion. The United Kingdom held roughly $895 billion. China's mainland holdings were about $694 billion. I look at those numbers and see support, yes, but not endless support. The buyer base is large, yet it is shifting, and some old assumptions do not hold the way they once did. I do not say that to imply some dramatic overnight dumping story. I have never trusted dramatic stories that are too neat. I say it because global buyers have their own pressures. Japan has its own yield issues at home. China has its own strategic priorities. Europe has its own energy, defense, and growth problems. Foreign capital still uses treasuries, but that does not mean every auction gets an endless line of carefree buyers. And that brings me to the bigger layer underneath the market. Bond markets are not only about math, they are about trust in institutions and trust in future restraint. If investors believe a country will keep borrowing, keep running large deficits, and quietly hope the central bank can smooth it all over later, they begin to ask for more compensation. That compensation shows up as higher yields. Higher yields then create even more deficit pressure. That is the loop. I have seen echoes of this pattern before. In 1994, the bond market got hit hard when investors were caught wrong-footed by tighter policy and rising yields. It was ugly enough that the phrase bond massacre stuck. The 30-year Treasury yield jumped from around 6.2% to above 8% that year. That kind of move punishes anyone who treated long-duration bonds as harmless ballast. It was a reminder that the bond market can humble almost anyone. A more recent warning came from Britain in 2022. The Bank of England later described how selling pressure from leveraged liability-driven investment funds, or LDI funds, helped wreck liquidity in long-dated gilts. Liability-driven just means a strategy built to match future pension promises. When yields surged, those funds had to sell into weakness to meet margin calls. Margin calls are demands for more cash or collateral. In other words, rising yields created forced selling, and forced selling pushed yields even higher. The United States is not Britain, and treasuries are not gilts. I know that. But market structure does not care about patriotic comfort. When too much leverage, too much duration, and too much confidence build up around a safe asset, the pattern can rhyme even if the details differ. That is the part I keep staring at, not the headline, the setup. So let me ask a question I think matters more than most daily news. If rates at the long end move 1 full point higher from here, do I know exactly where that pressure hits my own life first? If the answer is no, that is worth fixing before the market decides to teach the lesson for me. The deepest reason I think the bond market is next is political, not just financial. Nobody in power wants to be the person who cuts hard enough to truly change the debt path. Voters do not like spending cuts. Politicians do not like tax pain. And markets do not like growth slowdowns. So the easiest short-term choice is usually more borrowing, more rollover, more hope, and more pressure pushed into the future. The bond market eventually notices that pattern. That also puts the Federal Reserve in a difficult position. If inflation stays sticky, the Fed cannot simply slash rates and save everyone without risking another inflation wave. If growth weakens, it will face pressure to ease. If long yields rise because of supply and fiscal doubt rather than just tight policy, rate cuts at the short end may not fully solve the problem. The Fed can influence the system, but it cannot repeal arithmetic. I hear people say all the time that the Fed can just print money. Technically, central banks can create reserves and buy assets, but there is no free lunch hiding inside that sentence. If the market starts to believe the only answer to debt pressure is more central bank support, then the currency, inflation outlook, and long-term confidence all come back into the picture. A rescue can calm one fire and quietly start another. That is why I do not think the next phase will look clean. I think it will confuse people. Stocks may rally while bonds sag. Short rates may fall while long yields stay stubborn. Politicians may celebrate growth while interest expense keeps climbing. People will look for a single headline to explain it, but the real explanation will be structural. Too much supply, too much rollover, too much dependence on stable financing in an increasingly unstable world. I can see at least three paths from here. The first is the slow grind. Yields drift higher in an orderly way. Auctions keep clearing, but only at more painful levels. Mortgage rates stay heavy. Valuations compress. Nothing breaks all at once, but everything feels a little tighter, a little meaner, a little less forgiving. That is the kind of environment that quietly drains confidence over time. The second path is the recession path people think they understand. Growth weakens, short rates fall, and some parts of the bond market finally get relief. But even there, the relief may be uneven. The front end may rally more than the long end. The front end means shorter maturities like 2-year notes. If long-term fiscal concerns remain, the curve can steepen. A steepening curve means long yields stay higher than many people expect. The third path is the one markets always say is unlikely right before it arrives. A funding shock, a failed assumption, a disorderly auction, a leveraged unwind, a moment when the Treasury market itself needs official calming tools because the usual buyers step back at the wrong time. I am not predicting the date. I am saying the system is built in a way that makes the possibility too important to ignore. And if this kind of map helps you think more clearly about risk than the usual noise does, keep following along here, because the crowd almost always shows up after the pressure is visible, while I care much more about where pressure is forming before the noise starts. So what do I actually watch? I watch the 10-year and the 30-year more than the daily stock leaderboard. I watch how auctions are received. I watch whether term premium seems to be rising. I watch how repo funding behaves, because repo is the short-term borrowing market backed by collateral. I watch whether officials are talking more about liquidity, buybacks, and market functioning. Markets often confess stress through plumbing language before they confess it in prices. I also watch behavior, because behavior tells the truth faster than commentary. When pension funds shorten duration, that matters. When banks hesitate to use balance sheet to absorb volatility, that matters. When the Treasury expands efforts to support liquidity, that matters. When the New York Fed talks openly about a roughly $1 trillion basis trade and the risk of sudden unwinds, that matters. Institutions leave footprints before the public sees the animal. For ordinary investors, my takeaway is not to panic. Panic is expensive. My takeaway is to stop using lazy labels. Cash is not a long bond fund. A bond fund is not the same thing as a treasury bill. A treasury bill is very short-term government debt. Duration matters, structure matters, liquidity matters. I want to know what I own, how long it locks me in, and what happens to it if yields rise instead of fall. If I were trying to reduce blind bond risk today, I would start with very basic questions. How much duration am I carrying without knowing it? How much of my safe allocation can actually swing hard if the long end reprices? Do I have enough real liquidity, meaning money I can reach without selling something into stress? Those questions are not flashy, but they save people from expensive surprises. I would also remember that higher yield is not the same as higher safety. A long bond paying more than it did 2 years ago can still lose value if yields rise further. Reaching for yield without understanding duration is one of the oldest traps in the book. I have watched that trap catch smart people more than once because they confused income with protection. Those are not always the same thing, And there is one more question I think is worth sitting with tonight. If the one market that prices governments, mortgages, businesses, and risk itself is entering a more dangerous phase, do I really want to build my future on yesterday's idea of safety? I do not ask that to scare anyone. I ask it because markets punish sleepwalking much more than they punish caution. What matters now is not predicting the exact week something cracks. What matters is recognizing that the bond market is no longer a quiet backdrop. It is moving towards center stage. The debt load is larger. The refinancing need is constant. Interest costs are heavier. Foreign demand is still there, but less simple. Liquidity can thin faster than people assume. Leverage still hides in places that look calm until they do not. That is why I keep coming back to the same conclusion. The next big message from the market may not come from the loudest asset. It may come from the foundation. And when the foundation moves, every story built on top of it has to be repriced. That is the danger, but it is also the opportunity, because the people who understand the mechanism before the crowd usually make better choices than the people who wait for permission from the headline. I have lived through enough cycles to know that markets do not break where fear is obvious. They break where comfort is stale and assumptions are old. Right now, one of the oldest assumptions in finance is that the bond market will always be there to quietly absorb pressure, calm volatility, and save portfolios when risk rises elsewhere. I would not bet my future on that assumption staying this easy. The bond market is next, not because it is weak, but because it is too important to stay ignored. And the moment the safe part of the system starts demanding a higher price for trust, everything else learns what risk really costs.